So what's the key to a successful swing trade? Now you have to enter and exit a trade, and timing and when you get involved in the market can have a big impact on that. But if you think about it, if you enter at random and the outcome is random, you're going to get a 50% strike rate. You will make money 50% of the time. So, that's your base level, effectively, which you have to get at. But also, if you enter at random, you'll learn something very interesting about the way the market works, and that is that as soon as you enter a trade, you'll begin to uncover whether it's in trouble almost immediately. So when I hit the market with a particular trade, I'm looking for supporting characteristics around the market that allow me to confirm that what I've done is going to come true. So let's say we go into a market and lay. If we think that that's going to work, we can hold our position. But maybe it goes against us briefly. Well, at that point, you look around the market and you assess whether the position you've got is still relatively intact. Because if we have a large number of things in the market and they're all doing something completely different, it's lending weight to your position, then you can hold your position. The market never moves in a straight line. It doesn't go from here to there or from there to there. It sort of goes up and sort of heads roughly in that direction. But where a lot of people go wrong when they're swing trading is the market turns slightly against them and they're out. And then the market swings back in the other direction. They're thinking, oh no, how did that happen? It's what I call the watching over your shoulder syndrome. It's like somebody's there and pushing you around and making you make the wrong decisions. But if, for example, we had a theoretical two-runner race, okay, the book always has to be around 100%. So if we lay something and the price starts to drift, but the price on the other runner starts to drift as well, that's an unsustainable situation. Both of them can't drift at the same time in a two-runner market because one has to win, one has to lose, and the chance on one will directly affect the other. So if the price on something is drifting and the other one is drifting, then that's not a good position. You may have to start thinking about whether you need to exit at that particular point. But if the other one is charging in like a raging bull and is getting backed in heavily, then that lends weight to your position and you can just sit there. Even if the market goes temporarily against you, you can sit there and wait for the trade to play itself out. So you can immediately see that there's a correlation there. And as soon as you put a position into the market, you start looking around the entire market and you're sort of saying, well, that's doing that, this chart is doing this, and the activity here and the money in the middle is sort of heading in this direction. And each one of those get a tick or a cross. And if they all get ticks, then you just sit there and you think, well, go on then, off you go. Let's head off in that direction, make me some money. But if a lot of them are getting crosses, then all of a sudden the quality of your trade has fallen and you may want to consider changing your mind. Now, if you see those characteristics or the price goes against you and those characteristics are all turning negative, then of course you would get out. But if the price begins to turn a little bit against you and everything else generally looks like it's supporting it, then you do nothing. So, when the market is going in your direction, you have favourable characteristics, even if it temporarily goes against you, you can usually hold your position for a long period of time without panicking. If you look at whenever I do a swing trade, I'm generally not sort of, rushing to get out at any point. And that's because I can see all of the fundamentals of the trade are correct, and therefore there's no reason to change my mind. I'll just let the trade run. My biggest mistake is that suddenly it will snap back a little bit. So I may have been up 100, 200, and I end up, sometimes at zero, which can be a bit embarrassing. And that's just because I've let it go too far. And, you can overcome that by dribbling some of your money back out as the trade develops. But sometimes, I just pushed a little bit too hard and end up with nothing. But, however, if the price starts to move against me, I never sit there and think, I'm just going to hope and fingers crossed that this comes back in the other direction. Because if it goes down, and all of the characteristics are favourable elsewhere in the market and supporting that decision, then I basically will just hold that position. But if none of them are supporting it, then I'll just get out and take the loss. And that's the biggest problem that people have is, if you lose 30 or 40 quid, that feels a little bit painful. But the fact is you may get a 200 or 300 quid race in 2 or 3 races' time. And swing trading is all about making those little mistakes and then getting a nice big payoff. But I'd say that typically when you're swing trading, you can enter the market for a number of reasons, but very often it's the ability to exit correctly or not to exit too soon that determines the profitability of a swing trade. because the market doesn't move in a straight line. It will meander a bit. So once you're in that trade, the skill at spotting that that trade is broken down is probably more important very often than the entry. Though that said, there are some good entry setups as well, but that would have to be on a different video.
If you're interested in learning more about BetAngel, its tools and the opportunities they present, why not visit betangel.com today to download a free trial.